Welcome to the deep dive.
Yeah.
If you're looking for that shortcut to being truly well-informed about what's really happening in the market, well, you're in the right place.
Exactly.
Today, we're tearing into Inwido AB's Q2 FY25 results. They came out just yesterday, July 14th, 2025. Their CEO called it, interesting. And you know what that usually means in earnings call speak.
Yes. Code for not quite what we hoped.
Right. There's definitely a story here we need to unpack for this European leader in windows, doors, and installation solutions.
Indeed. And what's really fascinating here is watching how a key player, in building product sector navigates this complex, often pretty unpredictable macro environment.
Yeah.
So we're going to dive deep into what went on, try to understand management's core focus going forward, and critically see exactly how the market digested it all.
Okay, so let's cut straight to the chase then. Lay out the numbers for Inwido's Q2.
Let's do it.
They reported net sales of SEK 2.34 billion. That came in roughly, 3% below what analysts were looking for?
So that's right, yeah. About 3% shy of consensus. And their diluted EPS earnings per share also missed, landed at SEK 2.69.
Which was a shortfall of SEK 0.11.
Okay. So the top and bottom lines, a modest miss, but what's really notable and maybe a bit contradictory is how their operating EBITDA margin, that core profitability measure, actually held steady at 11.3%.
Okay, so profitability held up.
It did. However, despite having an all-time high order backlog, which was up a solid 9% year over year.
That sounds good.
Right. Sounds great. But new orders actually slid by 7%.
Ouch. Okay.
So that combination, it isn't just a modest miss on sales. It signals a real softening in, new demand. And that clearly concerned investors despite that stable margin.
Yeah, I can see why. So the CEO called the quarter interesting, but when demand gets pushed out again, well, that sounds more like challenging to me. He claims the fundamentals are still strong, believes they gain market share. Is that just, CEO optimism? Or is there real substance behind that claim when the market's so soft?
That's the key question, isn't it? Because it's easy to dismiss. But look, they truly are leaning heavily on really stringent cost control.
Okay.
And that massive existing backlog to weather these demand delays, their confidence really hinges on a demand pickup later this year.
The delayed recovery.
Exactly. Particularly as those energy efficiency incentives in Europe hopefully start to kick in. So yes, it is a volume and timing game for them. They're betting on those future catalysts to turn things around.
Okay. Digging a bit deeper then into the specifics. Net sales were flat year over year overall, but organically, so excluding acquisitions, there was actually 3% growth.
Which is respectable in this environment.
Yeah. And as you mentioned, that gross margin also held steady at 25.6%. Operating EBITDA saw a slight 1% increase year over year, keeping that margin at 11.3%.
That's crucial because while they held the line on profitability, we can't ignore some, underlying headwinds.
Like what?
Well, for example, a stronger Swedish krona actually shaved off 9 million EC from operating EBITDA, just currency effects. And then there's the product mix. Consumer sales, usually more profitable for them, they declined by 5%.
Okay.
While the lower margin project sales actually increased by 9%.
So a less profitable mix overall.
Exactly. But here's the interesting part. Even though they were selling more of the lower profit stuff, the underlying margin, what they actually pocketed on each sale, surprisingly improved.
Really? How?
It's just strong internal efficiency gains, doesn't it? Cost control really working.
Absolutely. That's a really important point to pull out. Okay, so what about those year-to-date figures then? January to June. They seem surprisingly robust considering this interesting Q2.
They do.
Sales up 5% overall, 6% organically. Operating EBITDA up 6%. Profit after tax surged 15%, and EPS grew 16%. What's driving that overall strength? Is it mainly geographic?
It really is. That's where the geographic breakdown becomes crucial. Scandinavia and Eastern Europe, for instance, they're really pulling their weight, showing improved results and margins. Finland's sentiment is improving slightly, and in Eastern Europe, those strong cost efficiency measures are clearly paying off. They're acting as a significant buffer against weakness elsewhere.
So some areas are definitely shining. What about their e-commerce segment? That's usually a growth engine, right? But it had a tough start to the year. They took corrective measures in Q1. Are those changes helping now?
They are, yeah. And it's a really vital area to watch. Despite lower sales in Q2 for e-commerce, the order intake actually edged higher by 7%.
Oh, interesting. So demand is there, just not converting yet.
Kind of. It looks like for them, it's really becoming a pure volume play for profitability now. They just need to scale up those sales to leverage their fixed costs.
Got it. And what about Western Europe? I imagine it's a bit of a mixed bag there, given all the economic headlines.
Oh, it's definitely tough. Especially England. That remains a very, very difficult market. Low consumer confidence, fierce competition.
Okay.
Management actually said they are strategically walking away from some projects with, quote, silly pricing.
Prioritizing margin over just getting the volume. Makes sense.
Exactly. Ireland, though, in contrast, remains more stable. That's a bit of a positive outlier.
Okay.
And we also heard about struggles at their peers, particularly in the UK. There were even reports of significant layoffs at a big Polish window manufacturer, so it underscores the broader sector pressures.
Right. It's not just Inwido feeling it.
Mm-hmm.
Okay. Moving to the balance sheet, they seem to be in a pretty strong position there.
Very much so.
Reported an improvement in cash flow from operations, up nearly 15%, and net debt is down quite a bit year over year by 230 million SEK. Now stands at SEK 1.517 billion.
And this is where their financial strength really shines. Their net debt to EBITDA ratio, it's at a very healthy 1.2x.
Wow. Okay.
Which is remarkably well below their target of 2.5x.
So lots of flexibility.
Exactly. Provides substantial headroom for more growth, strategic moves, particularly M&A.
We'll come back to M&A. What about return on capital?
Yeah, the return on operating capital, it's at 13.4%, still below their 15% target. But it has shown consistent improvement over the last 2 quarters. So better capital efficiency, moving in the right direction.
Okay, good. That strong balance sheet definitely gives them options. But let's talk about the order book again. The pipeline for future sales. It reached an all-time high, SEK 2.829 billion, up 7% year over year.
Yep.
Project backlog up a robust 12%. Consumer backlog, though, down 5%. Still, overall, that sounds pretty positive, right? A record high.
It is strong, yes, but there's that nuance again.
Okay.
While the existing backlog is at a record high, total new order intake actually decreased by 7% in the quarter.
Right, we mentioned that.
Yeah. And about half of that decline, to be fair, was due to a really unusually large order they got in Ireland last year, Q2. So it makes this year's comparison look tougher.
Okay, so a tough comp.
A tough comp, but it still highlights that while the future order book is strong, that new incoming demand is currently softer than, what they've maybe gotten used to.
Okay, so a solid foundation, but a softer new flow. Given that, how are they planning to drive future growth? Management mentioned M&A, that it's increasingly important.
Very much so.
They described an almost record broad and record deep funnel of potential targets. That sounds promising.
It absolutely does. And the CEO's comments, they really underscore the urgency here. He admitted he would be disappointed if they didn't close 1 or 2 acquisitions by the end of this year.
Wow, okay. So they're serious.
That tells you the intent and the momentum behind this strategy are significant. They're not just looking for little bolt-ons either. They're selectively pursuing targets, including maybe entering entirely new markets.
Beyond the UK.
Yeah, beyond the UK,
Yeah.
where they currently operate in only one of Europe's top 10 markets. So this is a clear path to, inorganic growth, buying growth.
Makes sense. And on the other strategic front, the green stuff, the green transformation seems like a major theme, particularly energy efficiency.
Yeah.
They seem to be eagerly awaiting clarity on the EPBD, that's the Energy Performance of Buildings Directive implementation. What's the timeline, the potential impact there?
Right, the EPBD. That's potentially a huge catalyst for demand down the road. They expect clarity on the implementation sometime in early 2026.
Not next year, then.
No, the CEO is clear the real volume impact accelerates in 2026, not 2025. But they believe it will be a major driver for their products. Think regulatory tailwind, pushing demand for energy-efficient windows and doors.
Gotcha. So switching gears slightly back to the margins, how
Yes.
did they manage to maintain them with all these pressures? What else came out of the analyst Q&A?
Yeah, a key takeaway from the Q&A was that Inwido has generally raised prices
Pricing power.
to offset those raw material and labor cost increases. That's basically how they've maintained margins despite the market pressure.
Makes sense.
Another point was the conversion ratio, how quickly orders turn into actual sales. It's currently lower than usual, partly due to that higher mix of longer-term project business, and also some weather-related delays in Western Europe back in Q1 pushing things out.
So the sales cycle is just getting longer for projects.
Essentially, yeah. Management called it the new normal for project sales conversion.
Okay. Any positive signs on demand during Q2? Did things get better as the quarter went on?
Yes, actually. Sales momentum did improve through Q2. June was notably better than April, apparently.
That's encouraging.
And order intake was relatively flat month to month, but it ended Q2 with a slightly more positive tone, let's say.
Okay.
Oh, and we also learned their new, more efficient Vietland factory is expected to boost profitability, especially once volume picks up. That should help margins in Scandinavia, particularly.
All right. So all that nuance, the strategic plays, the challenges, how did the market react to these results? Because it wasn't subtle.
No, it wasn't. Pretty dramatic, actually. The stock just plummeted, closed down significantly the day after.
On heavy volume, too, right?
Yeah, nearly triple its average daily volume. Investors, they cut straight to the chase.
What did they focus on?
Two things mainly, that revenue miss and the contracting new order intake. For them, a stable margin just wasn't enough to, sugarcoat the broader macro softness.
And it spread to peers.
It did. Their Nordic building products peers also saw sympathetic declines, maybe 2-4%. Inwido's guidance just signaled a slower residential recovery for everyone, really.
And it's easy to forget, Inwido shares actually had a pretty decent run before this, didn't they?
They did. They rallied over 15% from their April lows. That was after a strong Q1 beat and that surprise Swedish rate cut.
But those gains proved fragile.
Very fragile. Profit taking started kicking in around late June. That was right as housing starts data started to look weak again, and the buzz around renovation subsidies just sort of fizzled out.
Market timing, eh? Okay, all right. This is a segment where we throw out an outrageous but plausible trade idea, purely for intellectual consideration, of course. Remember, everyone, this is not financial advice. Please, always do your own research.
Absolutely. So, given Inwido's current situation, you've got a company with strong fundamentals, that record backlog, a healthy balance sheet, a clear path for M&A and the green transformation.
Wow.
But it's being punished by the market right now for near-term softness and that less favorable sales mix. So here's a thought for you.
Okay, let's hear it.
Consider a long position in Inwido, but with a defined timeline, maybe targeting the latter half of 2026.
Okay, and the outrageous part?
The outrageous part could be using some leverage, or perhaps buying some deep out-of-the-money call options.
Banking on what specifically?
You'd be banking on two key catalysts really coming through. First, the CEO hitting that explicit goal, closing one or two M&A deals by year-end. That shows execution, could re-rate the stock.
Right.
Second, that delayed but, seemingly inevitable clarity and implementation of the EPBD directive boosting volumes in 2026.
So the market's focus short-term, but the longer-term catalysts are still there.
Exactly. The market is pricing in near-term weakness right now, but the underlying catalysts seem pretty firm. It's basically a bet on strategic execution and those macro tailwinds eventually overcoming these current volume headwinds.
Interesting. A longer-term play betting on management execution and regulation.
Precisely. So just to recap everything, Inwido is skillfully navigating a pretty tough market right now. They're leaning on tight cost control and that robust existing order backlog.
And hoping for that demand bounce back.
Yeah, anticipating it, fueled by those energy efficiency incentives, and maybe more importantly, by actively trying to execute on that ambitious M&A pipeline.
So despite the market's current disappointment, management sounds optimistic about their strategic path, their fundamentals. The big question for you, the listener, is, are they just waiting for the tide to turn? Or are they really proactively shaping their own future here?
It's certainly a situation worth watching very closely.
We hope this deep dive into Inwido's earnings call has given you some valuable insights, maybe something to chew on. We'd love to hear your thoughts or any questions you might have. Until next time, stay well informed.